We're in a very interesting time in the real estate market. So I've kind of designed this talk to discuss where we are today and where I think we're going and some logic behind those assumptions, and talk about some opportunities and talk about how some more experienced investors can do some very creative things now. Real estate some people confuse the real estate business with real estate investing. And I'm not in the real estate business. I don't have a broker's license. I don't sell anything to anybody, so I've got nothing for sale. You don't have to worry about buying something from me. I'm an investor. And what I've done over the years, and I've been doing this for over 40 years now, is I've been taking pretty good notes. I've studied the business. So when I make a mistake, I write it down. And I started writing a newsletter back in the 70s, and I still write it. So when I make mistakes or I make good deals, either way, I write them down. And for you that are my subscribers, you'll know for the last 2 months, I've been writing about the coming change, and that was before we knew about the virus. I had a feeling that we were at the end of this run for real estate. You know, we had about a 10-year run going, and it's been a wonderful thing. But all good things come to an end, and I think the virus was obviously the impetus, the reason that we got shocked into where we are today. And the virus has been very interesting for people that are investors and in the businesses. It's not very interesting for people in the business. If you're in a real estate sales business right now, it's interesting to watch headlines where they say real estate sales are down. Real estate sales are non-existent. Nobody's buying anything right now, and the market will come back. But there's certain things that are going on right now that are really affecting that market. And one thing is the credit market has already made some adjustments, and very quickly the banks decided that they weren't going to make any high risk loans. That they were going to raise their credit requirements for people buying something as simple as a house. But the complicated deals, you know, the big deals, the bankers got very nervous about funding big deals, and a lot of times pulled the plug on them. So we're going to see a real slowdown in the construction business. And I'm going to show you a chart here in a little bit that shows about how many houses have been built in the construction effect, the building effect on demand and supply. So it's going to be an interesting year. I have lots of students. You know, I've been teaching since the 70s actually, and I stay in touch with all my students, and I have groups of them to get together. We had a group in Aspen the second week of February. And the second week of February, there was no discussion at all of the virus because it wasn't news yet. So it's interesting how fast this has changed. In just a couple months, we've gone from not worrying at all about some calamity to being affected by a sort of a worldwide calamity. Here in Florida, and I've been in Florida all my life, and I've been in business here in Sarasota, Florida most of my life, I have experienced a number of exciting days, and we call them hurricanes. And this virus is a little bit like a hurricane. When a hurricane comes through a town, it tends to destroy a lot of weak properties or damage a lot of the weaker properties. And everybody rebuilds after it's gone, and the government comes up with new regulations, new building codes. And at the end of the day, even though it's very painful going through the process, at the end of the day, the town is generally better. I was up in Panama City not too long ago. They had a storm a couple of years ago, and they're still recovering from it. But I have a lot of friends up there and students that went through that. And what we found was that the properties that were well built did pretty well. It was the older properties, the weaker properties, they got destroyed. And this virus is kind of doing the same thing, but you know, much more personal way, where people who have pre-existing problems are really at risk. So we have those people in our prayers. But so today we've got a short-term storm. That this virus is like a hurricane short-term. But then after the hurricane goes away, it's going to take a while. After the virus goes away, it's going to take a while for people to get back to normal. There's an awful lot of folks who, let's just say, that are working people that are not working from their home necessarily on a computer and still getting paid. But they're people that go to work, and now they're not going to work, so they're not getting paid. And a lot of these people are rent houses. A lot of these people are potential home buyers, but they're all going to be out of the market for some time to come. This is really going to set them back for some time to come. When I talk to my friends in the real estate business, the people that sell real estate, what they have found is that the moderately priced houses are actually still selling and still getting rented. That you can rent a house with no problem. But the higher priced properties um, are not moving very well, and that makes sense to me, because if I was looking to buy a $3 million or $5 million or $10 million house right now, I'd probably wait a couple weeks to see if maybe the price got a little better. And I suspect people in that category, people that can afford an expensive house, are pretty likely to wait and see how this is going to all work out. And it will work out. 3 or 4 years from now, this will just be a story. But we've got to get through this first. So if you're a real estate investor, that's different than all these television shows where it talks about they call themselves investors, but they're flippers. They buy a house, they try to fix it up, and on television it seems like they can fix them up in a weekend and they can do it for hardly any money. But in the real world, it takes a long time to fix a house up, and it takes a lot of money to fix a house up. And if you've never done it, the chances of you making a profit by doing that are very slim. So I don't encourage people to be in a buy, fix up, sell business, and that's a business. That is not a passive investment. But I do encourage people to invest in real estate. And I've invested in all kinds of real estate over the years. I started off buying apartment buildings and duplexes. I was in a land business. So I've owned a little bit of everything. I've owned some commercial buildings. But in the mid 70s, we decided that we discovered that the tenants that stayed in the houses that we owned stayed a lot longer. They didn't move out as fast. They stayed years instead of months, and they took better care of their property. They didn't call us for maintenance as often. So because of those two things, we started buying more houses, and as a sort of an experiment in the beginning. But after a while, we got serious about it, and we focused on buying better houses in our town. And my business for the last 40 years pretty much has been buying houses. Number one, my criteria is that I would move into. So if I wouldn't live in the house, I won't buy it. That doesn't mean I'm going to move into one of my rental houses, but it does mean that I'd feel safe there. My family would feel safe there. I'd get along with the neighbors. It would be a happy situation if I lived there. And that's a pretty good rule of thumb. So if you're going to buy any kind of real estate as an investment, you need to make sure that you want to own it for a long time. The mistake people make, and I made it early on, was to think I was going to buy something and then sell it for a profit in a very small amount of time, in a couple months or maybe even a year or two. And that just doesn't happen. The real estate market is not liquid. Everybody knows that. It's a disadvantage when you go to sell, but it's a major advantage when you're buying. Because when you find a seller and somebody approaches you and they need to sell a property and they need to sell it right away, they'll make you a deal. They'll give you a bargain price, because they would much rather have some money today than that property, whatever it is. So long story short, we've been doing it for a long time. We've never met anybody mad in this town. We've been in the same town our entire career, and our career is focused on buying houses that we can rent to long-term tenants who need a place to live. And we've been doing that for a while, and it's been working out. So I'm going to tell you a little more in detail about that. I have written a book, and you'll see it in this presentation, but I'll get to that in a second. So we're going to talk about where the house market is today, and I've been covering that in the last few minutes, where it might be in the future. I'm going to show you some charts here in a second that'll help bring that into focus a little bit. We're going to talk about some strategies for safe leverage. Leverage is an important tool to use when you buy real estate. It enables people to buy real estate that don't have enough cash to pay all cash for it. I invest in stocks, I invest in real estate, I invest in mortgages, I invest in several different things. But real estate gives me the opportunity to buy with the highest amount of leverage safely. And I'll go into some detail on that, but the safe part is important. The people that get in trouble with real estate over leverage, and they leverage with terms that they just can't afford to repay. So they end up in a problem with their lender. The lender wants a property back. The lender takes a property back. Depending on what state you live in, the lender can get a judgment against you, so they can recover all their money, or at least try to recover all their money. And then a final thing we'll talk about today are some opportunities for experienced investors. These will not be for somebody who's never bought a property before. These will be for people who are familiar with it, the idea of buying and holding on to investment properties. And I'll just talk about some opportunities that I'm going to see here in first few years after this crisis started. This is the book I wrote. This is the second edition. I wrote it originally in 2006, and we rewrote it in 2016 because a lot of things changed between 2006 and 2016. It's the bestseller through McGraw-Hill. We've got terrific reviews. It's an easy book to read, so I encourage you, especially if you're getting started in this business of investing in real estate. If you want to buy some property and houses or apartments or duplexes, I've owned them all, but I focus in this book on buying well-located houses and renting them long-term to people that need houses in your community. You know, you provide a service by providing a decent house at a decent price in a good neighborhood, and by doing that, it's amazing how people react. You know, we have tenants that have been with us more than 20 years. We've had a lot of tenants stay with us more than 10 years, and the reason people would do that, of course, is they're getting a fair deal. They're getting a decent house and a decent neighborhood at a fair price. Just a little bit on management. We do raise our rents. It's a mistake not to raise rents for 5 or 10 years and then raise them, a large amount, because you'll make your tenants mad. Even your best tenants will get mad at you and they'll leave. So it does you both. It's just good business practice to raise them a little bit on a regular basis. So we typically will raise our rents every year. Now, if there's a big recession going on and we have a bunch of vacancies, we don't raise rents, but when we're full, we certainly do. And over the years, I'll show you a chart here in a bit, but over the years, the rents have been very stable. The increase in rents has been very stable. And we found during the recession of 2006, 2010, in that period, that about 90% of our people just stayed in place. They stayed in place and paid a rent. There were about 10% that lost their jobs, left town. You know, they went someplace else they could get work. But the ones who kept their jobs wanted to stay in those houses. When tough times are tough, people don't want to move around. You know, moving is not a lot of fun, even on a best day. But you certainly don't want to move when things are tough. So people tend to want to stay in the houses they're in, and if you're giving them a fair rent, there's no reason for them to go anyplace else. Let's talk about what's happened here over the last 50 years that I've been in business. We started in the 70s, and you can see this chart starts in the 70s and runs through 2000 and probably 15. I don't think we're quite to 2020, but you can see the red line represents inflation during that period of time, and the blue line is the median house price during that period of time, the amount of increase in house values and house prices. Now, people argue the difference between house prices and house values, and I certainly understand that. But, to me, what I can buy a house for and what I can sell a house for are the two numbers that are most important. Whether or not we're talking about inflation adjusted dollars or not too critical, but it's important to me to buy an investment that keeps up with inflation. And you can see by this chart, the red line being inflation, that houses have kept up with inflation for a very long period of time. And there's a couple reasons behind that. To build a new house, you have to buy material, labor, and land. And those three commodities keep going up in price, especially in a town that's growing in size. We will talk about demand and supply in a second, but if your town is not gaining in population, if your town is losing population, then your land is becoming less valuable. And the land is a major component of the housing price. But if you're in a town where they're building new houses and there's a lot of new construction, the cost to replace a house, the cost of a new house is significantly higher than the cost of an existing house. So if you can buy an existing house, especially if you can buy it at a bargain price, you've built in a nice profit for yourself, and you're in a position where you can rent the house for a decent return. So two benefits of the owning a house. One is the inflation hedge. It keeps up with inflation. And part of the reason house prices go up is the devaluation of the dollar. You can see how much the dollar has gone down since 1980. And everybody has an opinion on inflation, but I think the government's doing a good job right now of helping increase the amount of money in circulation, both through printing money and giving some money away, sending checks out, and by loosening credit, by making it available to the banks so the banks can make loans. So will house prices continue to beat inflation? We've seen some big swings. You can look at the curve here between 2006 and 2010. You can see house prices drop pretty dramatically, but now they're back up again. So there tends to be cycles, and there's no magic cycle. There's no 7-year cycle or 10-year cycle that repeats itself over and over again. But houses tend to have a fairly steady increase over a long period of time. So if you do buy a house as an investment, you should have a long-term outlook. You should not be thinking you're going to sell this next year or 2 years from now and make a big profit. You should, in my books, I recommend that you should think that I'm going to hold this property until it doubles in value. And if you think that way, if you buy a house today that's worth $250,000 and are committed to holding it until it doubles in value, depending on where you live, that could take some time, and depending on inflation, that could take some time. But if we have a lot of inflation, it'll take less time. And if you have a lot of people move into where you live, it'll take less time. These are new home starts. This is reported by the Federal Reserve Bank. And you can see that the line is not very steady, which means, and you can see the gray areas, you'll see times of recessions, and you'll see that the line drops down dramatically during these recessions. And what's interesting about the current period, and this chart is fairly current, is that we're way below the peak of last time, and we're below even the average of the last 20 or 50 years. We're not building as many houses right now, and at the same time, we have a growing population. The baby boomers, and I'm one of the baby boomers, had children. All my children are in their 30s now. They're all having children, and guess what? Baby boomers' kids who are having children want to do? They want to live inside. And most of them want to buy a house. And there was a lot of talk about that not happening for a while, but it is happening. I have firsthand information on that. And of course, I'm in the market. I talk to people all the time that are looking to rent a house, looking to buy a house. And a lot of the younger kids, even in their 20s, are buying houses. They see them as a good investment. They see them as a conservative investment. They see them as a better alternative than renting. So until we get the production of housing up, and of course this is just talking about new houses here, this chart shows nothing about the older houses that are becoming uninhabitable or obsolete or too expensive to maintain. And there's a lot of that inventory out there. There's a lot of houses that were built 50 years ago or longer that are not very attractive to the marketplace anymore. And don't take that as a guide, because of course a house that's 50 years old can be in an excellent condition. A house 100 years old can be in excellent condition if it's well maintained and in a good area. So it's not as simple as saying how old a house is. But my point is, there's a lot of older houses out there that are not well maintained, and they are not attractive to new buyers, and they're not attractive to lenders. Lenders don't want to make a loan on a house that's in bad shape. So be careful what you invest in, and I've always encouraged people to buy the highest quality property they could, the highest quality property they could. Where people are moving. This chart is interesting to me because Florida down there in the bottom right-hand corner has got the right color. It's got the dark green, along with a number of other states that are picking up population. If you live in a state that's not picking up population, it doesn't mean your property values are going to drop necessarily, because there'll be parts of that state that are still the best parts. They'll be very attractive. So these are broad brush comments here. But obviously, if you live in a state that's picking up a lot of population, there's going to be a lot of pressure on the government, and the pressure that people put on the government once they live in a place is that they don't want new people moving to their town. They want to keep the town small. They want to keep the same personality. They don't want their streets crowded. They don't want busy schools and busy stores. Not the businessmen necessarily, but new people moving to town. And we've seen that across the country. In this town, they continue, in this state of Florida, they continue to increase the regulations for building. They increase the regulations for land development. So when I first started in business, you could actually buy a piece of land and develop it and build a house probably in less than a year without much trouble. Today, that same process may take 4 or 5 years. Well, when you add that much time to the process, you add a lot of money, a lot of cost to the process. Somebody has to pay the interest on the investment on that land and the building going up all that period of time. So prices will continue to go up, and especially prices will continue to go up in areas where we have growth. So know your town. And I teach a class once a year here in Sarasota. And in the class, we actually have our students go out and walk through neighborhoods and get to know people who live in those neighborhoods and talk to people who live in those neighborhoods and ask them if they know anybody who might want to sell a house. And by doing that, they learn an awful lot more than you would learn that if you were just doing it on a computer, because the face-to-face contact is important. Now we're missing that right now with the virus, but hopefully sometime soon we'll be able to have face-to-face contact again, and that's really kind of the fun part of the business. Balancing leverage with risk. This is just a very simple example, and the example is here to get you to think about whether or not leverage is a good thing for you. If we take a house, and this house price I picked is kind of an arbitrary price, but I picked it because it's pretty common in my town. You can buy a decent house in my town, a 3-bedroom, 2-bath house with a double-car garage in a decent area for about $250,000, and that house would make a good rental. So if you're buying a house to hold long-term as a rental, that's the price range you look for here. Now across the country, there's a broad range of prices. I have students in Orange County, California, and in San Francisco. I've got students all up and down the West Coast. We have students in Mississippi and Georgia, Tennessee, and Kentucky, and all these people have different markets they're dealing with. And in some markets, where you can still buy a house for, say, $100,000. There's nothing wrong with that house. It'll look just like the $250,000 house in my town, but the $100,000 house is not going to go up as much. The benefit of buying that $100,000 house is that your cash flow will be higher on a $100,000 house. So if you want to compare these houses to different types of houses, different price range houses, to different stocks, you can buy some stocks that have high dividends, but maybe not as much growth potential. You can buy some stocks that have no dividend and maybe tremendous growth potential. Warren Buffett has used that model well. So if you don't ever pay a dividend, you accumulate a lot of cash, you accumulate a lot of equity over time. Okay, so the houses I like to buy have both. They have both the appreciation potential, and over the long run, a house that sells in Sarasota for $250,000 today, and then I own those houses. We bought a lot of those for $50,000. So they've gone from $50,000 to $250,000. Will they continue to go up? I think they will. Between inflation and the cost to reproduce these houses, there's no reason to see a reversal in that trend. Again, the people that buy a $250,000 house or rent a $250,000 house, are they the same people that did that 30 years ago, 40 years ago? The answer is yes. They have the same jobs that they had 30 and 40 years ago. A lot of them are teachers, school teachers. We have people in sales. We have people who are construction people. We have people all across the board. That have different types of jobs. When I look for a tenant, I look for somebody who has a skill, a marketable skill. If somebody can't define what they do, by explaining to me how they can market their skill and how they can get paid for that, I'm less excited about renting to them. So we're looking for people when we go to rent a house that have long-term potential. In fact, one of the first questions I ask people when I rent a house is, how long do you want to stay in this house? And I try not to give them any clues. I don't want them to think that I'm looking for either a short-term or a long-term person. I'm looking for somebody who will give me an honest response and likes this house. And one of my favorite tenants, who's been there for a long time, answered. And I add, this is on a written application. The question is on a written application, so this isn't a face-to-face meeting. But the answer she gave me was the rest of my life. Well, that's the correct answer as far as I'm concerned as a landlord. I want somebody to be committed to stay the rest of their life in my houses. That's a wonderful thing for both of us. When you compare the income stream from a house that's rented to the same tenant for 10 or 15 or 20 years to an apartment building, to a unit in an apartment building, or to a duplex unit, and I've owned both, you will find that even though the per square foot gross rent will be lower, the net rent is higher. And the reason the net rent is higher is because the vacancy is lower. And when you have low vacancies, that means you have low turnover. You don't have people moving in and out of your apartment or your house very often. And if somebody will stay in a house for 5 or 10 or 15 years, and most of my tenants do, that keeps my maintenance costs remarkably low. When I had apartment buildings and rented apartment buildings, people would move in and out every 6 months on a regular basis. If somebody stayed a year, I thought that was a home run. Well, if you're painting something every 6 months instead of painting something every 5 or 6 years, your paint expenses are much higher, even though that unit is smaller. So what we've learned over the years is we want, number one, we want as passive a portfolio as we can have. As passive a portfolio as we can have. And a passive portfolio in a real estate business means one where people aren't coming and going all the time. I kind of say it this way: I want as few moving parts as possible. I don't want to have to deal with this every day. I manage all my own properties, and I have quite a few properties. I couldn't do that if I had high turnover of my properties. On a typical month, I may have 1 or 2 calls from a tenant. So it's very low maintenance. These people tend to want their privacy. They tend to want to take care of the houses themselves. If they have a big problem, if they have a roof leak, air conditioner quit, big plumbing issue they can't solve, they'll call me. And that's not a big problem to me because I allocate a certain amount each month and each year. I know what it costs me to maintain a house, so we set that money aside. And so if somebody has a problem, we simply call the people that we deal with, and then we deal with the same plumber and the same electrician, the same AC guy. We deal with the same people. We call them and they fix the problem. So somebody told me a long time ago, if you can solve a problem by writing a check, write the check. And we can. We have the cash flow to write that check. So when we have a maintenance request from a tenant, our job is to solve that problem as soon as we can, and that makes that tenant very happy. If I can solve a problem in a day or even 2 days, that makes that tenant pretty happy. Where tenants get unhappy is when landlords don't maintain properties and they have chronic issues and they go on for months or even years. Those tenants, the good tenants, move out. We've rented to a lot of people, and they tell us on a regular basis that the reason they're renting our house, number one, is it's the cleanest house they've ever seen. We make sure our houses are really clean. But number two, the old landlord wouldn't fix anything. And they can see by the condition of our house that we fix everything. Our houses are in good shape. Now we expect the tenants to take care of them once they move in, and that's a whole different speech. But if they don't take care of them, there's penalties, financial penalties for not taking care of them. So let's look at this example for a second. We have a house here, $250,000 house that has net rent. Now, net rent is the rent after you pay your taxes, insurance, and maintenance. After you pay your taxes, insurance, and maintenance. The net rent on this house is $1,166 a month. And of course, that's not an exact number because but you want to give yourself a range when you rent a house, but I had to do math here so you get the feel for it. So $1,166 a month, and that's after you paid your taxes, that's after you paid your insurance, that's after you maintain the property, and that's after any vacancy cost. So your net rent is the amount of money you get to keep from that house this year. And those numbers reflect reality in my town. Depending on where you live, the prices will be different and the rents will be different, so you'll have to do a little research to see what makes sense in your town. But this reflects reality in my town. So if that house was owned free and clear, if I paid cash for that house, the cash flow the first year, year one, would be $14,000 or about 5.6%. I am pretty happy with 5.6% these days. Now, I will tell you that if I buy a house that's worth $250,000 and I buy it for all cash, I will be looking for a bargain price. I won't be looking to pay the full $250,000. I'm not trying just to put money into real estate. Hopefully, I'll buy that house for considerably less, maybe $200,000. And of course, if you could buy it for $200,000, your rate of return on your cash flow would be higher. But 5.6% is far more than I'm making in CDs at the bank, and that's year one. Now, the reason I say year one is what happens in year two and in year three and in year four. And the answer is rents go up. Rents go up. The houses that I bought for $50,000 and now are worth $250,000 used to rent for $300 a month, and now they rent for $1,800 a month. So the rents go up as steadily as the house prices, and even more steadily. I'll show you a chart on that in a second. So 5.6% return. That's if you bought the house for cash and paid a retail price, all cash. If we financed it today, you can get a 30-year, 5% interest loan. And there's a zero missing on my example here. It should be a $200,000 loan, $200,000 loan that would have payments of $1,073 a month. Well, if you're collecting $1,166 net rent and you're paying out $1,073 a month to the bank, okay, because that's after taxes and insurance, your cash flow the first year one, would be only $516. But of course, you only have $50,000 invested. You get to choose which of these plans you like. I have people take my class sometimes that have no money at all. And I have other people that take my class that have a lot of money. And the people with a lot of money want to invest a lot of money in real estate because they see it as a hard asset that is a good inflation hedge. It gives them a fair return on their cash. The people that don't have much money need to use leverage. Now, there's a way to use even more leverage than an 80% loan. That's beyond the scope of this discussion. If you get a chance to read the book, I have several examples in the book about how we bought property with lower down payments, but with leverage that works. You want to balance the leverage with the risk. You shouldn't buy a house, and this 30-year loan house, I would just call that a break-even deal, even though it makes $516 a year. That's too close to celebrate. That's about a break-even house. But if you hold on to that house for 5 or 10 years, it'll be a strong house. You'll have significant cash flow in that house. And, depending on the economy, but with a little bit of luck, it'll go up in value over 5 or 10 years. And now you'll have a capital gain in addition to more cash flow. So the risk we take in real estate is, in my mind, lower than the risk you take when you leverage your stock investments. The stock market can move so quickly, and real estate can drop too. But the difference is, if I have a $200,000 loan on this $250,000 house, even if that $250,000 house drops in value to $150,000, and now I have a $150,000 house with a $200,000 loan on it, the bank is not going to ask for their money back. There's not going to be a margin call. I don't have to pay them back. Once we have that contract with the bank or with a lender or any lender that says I can pay you back the $200,000 at 5% interest over 30 years at $1,073 a month, it's a contract that they can't renege on. They can't call this up one day and say, we'd like our money sooner. Okay, everybody clear on that? It's an important point. Some opportunities for experienced investors. We've been through a number of recessions. My first recession was pretty exciting. Everybody asked me, how was that first recession? It was not good. I was a young man. I was in my 20s. I thought I was a genius because I had a college degree. I had a real estate broker's license. I had made quite a bit of money. We had several good years where I made quite a bit of money. So I thought I was the smartest guy in town. And that's dangerous because then we started getting into deals with financing that looked good the day I bought it, but then we had a significant recession in the mid 70s. And when that happened, Property values didn't drop dramatically, but they became very illiquid. It was very hard to sell things. People were not buying. And when that happens, and then we have some short-term financing that we need to renegotiate or refinance, we had a hard time doing that. We ended up selling some of those properties at losses. And I learned a very important lesson. And one was short-term financing is a bit of a challenge. We are much better off because we can borrow to buy real estate with a long-term loan. It's not true in every country. One reason we get a lot of foreign investment in this country is because of the financing available. We have students and friends in countries all over the world that don't have 30-year loans. A lot of them have 5-year loans. They have short-term loans. And one advantage we have in the residential business over a lot of people in the commercial business is that the commercial people end up with short-term loans, and they end up renegotiating them on a regular basis. They end up refinancing on a regular basis. So let's talk about a couple of these things. Buying properties from speculators and builders. There are a lot of folks that are building spec houses, they call them, the houses they expect to make a quick profit on. And some builders are just building because they build, and they won't stop building until they can't get rid of the last house. We have found that by buying houses from builders in these recessions, we get an excellent deal because we get a brand new house, which is really easy to rent. We'll have very low maintenance for a long period of time. And then, people who are not buying these houses, we have the builder, and then the other opportunity we have is we have the lender involved sometimes. And we have a lender who doesn't want the house back, and we have a builder who doesn't want the house. We can get involved in that situation and negotiate a deal with both the builder and the lender and get a bargain price and get a loan that we're happy with and have a brand new house, which we know we can find tenants for. Number two here is buying higher quality properties with cash flow. The opportunity, a lot of people end up buying properties that are not the best properties to start with. I certainly did. When I started in this business, I bought a lot of properties that people would call lower end properties. They weren't even blue collar properties. They were properties that people rented that didn't have much money. And I thought that was the way to go because I thought that was a way you collect a lot of cash flow. And then what I learned after a while, after I had some cash flow, was that it was a lot more work. Owning properties that were lower quality properties, they're pretty easy to rent. Let me say it differently. They're pretty easy to fill up with people, but you have to work to collect the rent. Okay? The tenants I have today all pay the rent. We don't ever have to go out and collect the rent. They are so happy with these houses. They love living in these houses. They like having me as a landlord because I take care of their properties. They like the idea that they have fair rents, and I won't say way below the market, but they're certainly not above the market. They're fair rents. So they would do a lot to stay in these houses. Now, the opportunity you have when we have a slow market like we will have, I think, for the next couple of years, is that you can notch up a little bit. If you're already buying real estate and you started like I started, buying maybe duplexes and apartments and some lower end houses, you've got an opportunity to use those properties actually as currency. If a builder has a new house, I had a builder who had 13 new houses that we bought from him. And I was able to buy him by giving him one other house that I have, which was not as nice, but it was paid for. It was a free and clear house. And I gave him a free and clear house for his equity in those other houses. By doing that, he was happy because he went from 13 houses that he didn't want to one house that he didn't really care about, but it was free and clear and it had cash flow. So there was a major benefit to the builder to make that deal. I wanted to acquire a lot of assets. I knew it was the time that low prices. I knew what it cost to build these houses. I knew I was buying them for less than what it cost to build them. A little insight in financing. All these houses had 14% loans on them. So this is back in the 80s. They all had 14% loans on them. And yet I still own most of those houses today. People are real excited about low interest rates, and I'm all for low interest rates. I'm not in a borrowing business anymore. I don't need to borrow money. But I got to tell you that if I were getting started, I would be borrowing all the money I could at 4 and 5 and 6%, and even better than those rates maybe. But investors end up paying a little higher rate than a homeowner would. But homeowners who are buying houses with 3 and 4% loans today are making terrific deals. They'll have low rent in effect. They'll have low payments for the next 30 years. If they don't go out and refinance those houses, they'll do very, very well. I was a Habitat for Humanity volunteer for 25 years and helped them build a lot of houses. And I've seen a lot of those folks have paid off. They had 20-year loans. Many of those homeowners have paid off those 20-year loans, and now they own that house free and clear. And that's a wonderful thing. I encourage people, homeowners and property investors, to own properties free and clear. The nice thing about a house portfolio is that, let's say you had 10 houses and you wanted some leverage, you could own 5 of the houses free and clear, and you could put all the leverage on the other 5 houses. So you might have 5 houses with 70 or 80% loans, and you may have 5 houses that are free and clear. And that balance in your portfolio is possible because they're separate properties. If you just had one big apartment building, you couldn't structure that. But by having some free and clear, you'd have a lot of cash flow off the free and clear houses. And the houses that had leverage would give you a higher return on your money because you're leveraged, and when you have a 10% growth and you've got a 20% down payment, you're making a terrific return on the money you have invested. So you can balance out. So the house business has a lot of advantages. I have a short period of time today, so I can't cover all of them for you, but if you get a chance to read the book, you'll learn a lot more. Number 3 here, buying debt at a discount. Buying debt at a discount. That's probably an interesting concept to some of you, but banks and all lenders, private lenders and bank lenders, and there's a lot of private loans made. When we have a downturn, many of them make relatively high risk loans, or they certainly look like high risk loans once we have a downturn. They'll be lending to builders who the only way to repay that loan is to sell the house. One thing a builder is not going to do is they're not going to rent a brand new house. They're only going to sell that house. If they can't sell it, they'll probably just walk away from it. They won't rent it. They'll probably just give it back to the bank. Well, if the banks, they may be put on a happy face here for a couple months, but if they start taking back a lot of properties, that really hurts their financial statement. And of course, it hurts their cash flow. If you're a lender here and you have this $250,000 loan and you have payments coming in each month, and then all of a sudden somebody just gives you the keys to the house, you not only don't have the money coming in every month, you have to write a check every month for taxes, insurance, maintenance. You've got to keep the air conditioner on, mow the grass, keep the house up. So it's a terrific swing in our cash flow. And so when banks have a number of foreclosures, it really hurts them. That's why if you're an experienced investor and you see a situation where the lender does not want the property, you can go to that lender and quite often either discount the loan, or the next line here talks about restructuring the existing debt. I'll give you an example. We had a house with a first and a second mortgage on it here in Sarasota. Had a first mortgage of about $150,000 and had a second mortgage of about $50,000. Well, if you understand how this works, the person or the lender with the second mortgage doesn't get paid until the first mortgage receives all their money. So if there's a foreclosure on this house, and let's just say the house is worth about $200,000, if there's a foreclosure sale on this house, it's not going to sell for $200,000. It would be lucky to sell for the $150,000 that's owed on the first, and there's a good chance it'd go for less than that because it's an all cash sale. So we were able to buy that second mortgage rather than buying the house. We bought that second mortgage at a significant discount. We bought it for just a few $1,000s. And then we went back and talked to the people who owned the property, and were able to work out a situation with them where they could afford to make the payments on the first. They just couldn't afford to make the payments on the second. So we let the payments on the second accrue. So a person dealing with another person can make a deal many times that a banker who's an employee at a bank and is dealing with all sorts of regulations and rules. just doesn't have the flexibility to make. And it's not that the bankers are bad people. A lot of my friends are bankers, are nice folks, but they just don't have the flexibility to make a deal because of all the regulations and then all the rules, internal rules for that particular lender. We had a real opportunity last time with all the private lenders. There are a lot of private people who are making high interest rate loans to folks who are speculating. They were buying and selling houses, and a lot of that debt was not paid off in full, and we were able to buy a lot of that debt at a discount. So that's certainly an advanced topic. If you're just getting started in investing in property, I don't want you to start there. I want you to start by learning the basics, thinking about which property, things you can control, which property you buy, how much you pay for it, how much you put down, what kind of monthly payment. These are things that you can control, and have a plan. Put together a business plan before you start buying properties. Know how many you want to own, and as I said earlier, you'll be happier with as few moving parts as possible. I'd like to own as few properties as possible and make the numbers work out. So you have a cash flow goal, you may have a net worth goal. In my mind, the cash flow on a monthly basis is more important to me. If my net worth goes up or down next month, that's not too critical. But if my cash flow goes up or down, that's important. So I pay more attention to the cash flow than I do the net worth side. It's been a good business for us, being able to provide affordable housing for folks in our town, being able to solve problems, serious problems for people who can't make payments on their houses, for builders who can't sell their houses. So there's a lot of opportunity to help people in your town on both sides of the page. I can tell you that in all the time we've been doing this, we don't have any unhappy folks. We try to, we're relatively high profile in this town, and we try to do business in such a way that our customers are always happy. So thanks for your time today. This is going by pretty quickly. You can look at my website, which is johnschaub.com, for more information. And if I can ever be of help to you, I'd be happy to talk to you. Thank you very much.